then over there trading activity will be higher, which means more buying and selling gonna be occur. People are confident to buy your shares and also confident to sell. So in that case, the company value also increases. So here we go. We have successfully finished this lecture. This chapter. So the chapter summary is that I'm just going to read it. If there is explanation required, I will, explain that point. Just going to read that. The foreign exchange market allows currency to exchange in order to facilitate international trade or international transaction. Commercial banks serve as the financial intermediaries in this in this market. The international money markets are composed of several large banks that accept deposits and provide short-term loans, because we are talking money market. So money market provides short-term loans in various currencies. So this market is used primarily by governments and large corporations. Sorry. The international credit markets are composed of the same commercial banks that serve the international money market, right? These banks convert some of the deposits received into loans to the governments and large corporations. And we talk about that. What do we mean by medium term? Like 3 to 5 years loans, we call that medium term. The second large summary point is that the international bond market facilitates international transfer of long-term credit. What does it mean? So it means we are buying the international bond of different country. So for example in euro, so if something happened to that country, the value of the euro is increased or decreased, or there is the risk to the international bond, that is exchange rate risk, the liquidity risk, and the credit risk going to be increased or decreased. So that's why the international bond market, they transfer these kind of risks, and these are the long term, because international bonds are issued for like 1 to 10 years, 10 years, 15 years, 20 years. Government needs, these kind of funds for long term purposes, also the large corporations. So the international bond market is facilitated by multinational syndicates of investment banks, and that help to place the bond. So one example that can be is that if a government wants to build a dam, a dam cost like $500 billion. It's a huge amount. For to satisfy that loan, there are syndicates, or there are many banks that join hands together to satisfy that loan. So this also facilitates the international bond market. The international stock market, it enables to obtain equity financing in foreign countries. Thus, these markets help MNCs finance their international expansion. And we talk about that why companies go to issue shares outside of their home currency. Number one is international expansion. Number two, to gather more funds, because if they issue in their home home country, maybe uh, the amount they expect to raise is not up to the the ability of the local investor to absorb that kind of financing. Okay, now we will start a new chapter 4, which is exchange rate determination. So we will be covering the learning objectives, like how exchange rate movements are measured, how equilibrium exchange rate is determined, and the examining the factors that determine the equilibrium exchange rate, and explain the movement in cross rates, that is very important, and explain how financial institutions attempt to capitalize on anticipated exchange rate movements. Means what are the managerial, decision makings in anticipation of exchange rate movements. So let's start from our learning objective 1, that is measuring exchange rate movement. We have a slight idea what is depreciation and what is appreciation, and now we quantify that idea. So the depreciation is the decline in a currency value. Appreciation increases in the currency value. So comparing foreign currency spot rates over 2 points. Remember, this is spot rate. For example, today is the value of 104, and tomorrow is the value of 105. So how much is the percentage change, right? This is called appreciation and depreciation. So here we go. So the percentage change in the value, we can find out appreciation and depreciation. So it's like new value minus old value divided by old value. The simple percentage change formula. Spot rate, new spot rate minus old spot rate divided by old spot rate, right? Let me just clear the formula so that you can understand well. Here, S minus ST minus 1 divided by ST minus 1. So a positive percentage change indicates the currency has appreciated. The negative percentage change indicates that it has depreciated, right? Here we go. So exhibit 4.1 it shows us how exchange rate movements and volatility are measured. So you see here, January 1st, the Canadian dollar, in terms of dollar, the price of Canadian dollar is $0.70, and on the same January 1, the value of euro is $1.18. On February 1st, the Canadian dollar price was increased to $0.71 and euro $1.16. So what happened here? Let's find out whether the currency has appreciated or depreciated. Let's talk about this. Here, this is the value of Canadian dollar. So what is the formula for depreciation or appreciation? New spot rate, which is 0.71 minus old spot rate 0.70 divided by old spot rate 0.70. Answer should be 1.43%. Here we go. And how this value is calculated? So let's talk about this. So let's do that. This is new spot rate 1.16 minus old spot rate 1.18 divided by 1.18. Answer is, since this value is old spot rate value is higher, so here answer is 1.69%, right? Similarly, if I ask where this value came from, your answer should be the old spot rate is 0.695, new spot rate 0.686 here. So new spot rate 0.686 minus old spot rate 0.695 divided by 0.695, right? Answer should be minus 1.29%, right? Now question arises, how are we going to explain this appreciation and depreciation, right? Let me just erase all this so that we can understand well. Here we go. So this is how we measure the exchange rate movements. Okay, from January to February 1st, the Canadian dollar was appreciated by 1.43%. During the period of February 1 to March, it is depreciated by 1.99%. And then in April, May, it is depreciating. June 1st, appreciated, and again depreciated, right? Now look at the other side, which is the value of euro. Euro has depreciated 1.69 and then depreciated 2.86, 2.61, 0.89, and here from 0.89% to straight jump of 2.79%, and then it's appreciating, right? So this is how we explain that currency has appreciated or depreciated. So then what is volatility? Volatility is the risk that how much the currency can change, right? So if you want to find out the volatility, this is the standard deviation. So standard deviation of all these items, this is called risk. So the standard deviation of Canadian dollar is 1.04%. It means there is a risk that the currency will move up and down to 1.04% in every other next month. So in August there is a chance that currency going to be appreciated by 1.04%, either up or either down, right? That is the risk. In finance or in mathematics, the standard deviation is called the risk. So can you explain that? Yes. If your answer is that by the time of August the currency would be appreciated or depreciated by 2.31%, this is the maximum, or you can say that this is the risk band. Okay, here exchange rate equilibrium. So exchange rate represents the price of the currency. We already know that. There is no need to explain that. So it is the rate at which one currency can be exchanged for another. Then what is the demand for the currency? So demand of the currency are created by buyers. So demand for the currency increases when the value of the currency decreases. Right? If you want to buy the product, you want to buy at cheaper price, right? So demand of the product increases when price. Similarly, the law of demand says that if price goes up, quantity goes down. If price goes down, quantity go up. This is the law of demand, keeping all other things constant, right? So demand for the currency is that when the price go up, demand go down. If the price goes down, demand go up. So demand for a currency increases when the value of the currency decreases, leading to a downward sloping demand schedule, right?